Hi, Lynn.
Hi, Cam.
Great to be here. We're doing the monthly economic update.
Yep.
How's your last month been?
Well, news-wise, it's a very eventful month. Work-wise, busy month as always.
Yeah,
Yeah.
there's a bit on at the moment, which is good. So as you say, there's been a lot happening in financial markets and economies worldwide over the course of the last month or so. We've got a bit to get through today.
Yeah,
let's,
definitely.
Let's make a start.
I guess there are a few topics we want to talk about. Broadly, I guess it would be helpful if we start by reflecting on what has happened, especially at the US trade and policy front. And then we're going to dig into the actual economic data that we have seen in the past 1 month. And I guess it will also be beneficial for us to bring the conversation back from the long-term perspective so we can share some insight that can help our investors to stay focused on what is really important in the current condition.
Yeah, spot on. That's right. Yeah, excellent.
We're going to start with US trade and tariff in the past 1 month. I can't believe it has been 1 month now. Our last podcast was actually literally on the Liberation Day. I know.
That's right.
We didn't touch on too much at the time because...
Yeah, nothing came out.
Yeah, exactly. Now, a lot has happened since then. And from 2nd of April, the U.S. administration, they announced a high level of tariff pretty much with every major trading partner globally. And that apparently shocked the market. And both the bond market and the stock market have been quite reactive to that announcement.
Yeah, that's right. I think one of the things that we saw is, the major indices, can we use that, that what we see in the newspapers every day plunged.
Yeah.
The major indices plunged, and we saw the S&P 500 fall on that particular day by around 6%. And then over the course of the next few days drop by 12%.
Yep.
But of course, one of the more interesting factors here is that we also saw the Treasury yield on US Treasury bonds. It rallied or increased, surged to around 4.5% from about 4% over the course of a few days as well. So, that was really problematic and for the US government.
Yep. It definitely, and quickly after that, things shift quite a bit. And after 1 week, and Trump announced a 90 days tariff pause.
Yeah.
And that just changed the dynamic quite a bit. And since that, the market rebounded sharply, and we pretty much recovered to the pre-Liberation Day level now.
Yeah.
And I guess one interesting observation in April is, as you mentioned, we have seen one of the worst days in the market, in US market, but also one of the best days in US market, just within a short period of time.
Yeah, well, that was the S&P rallying by about 9.5%, I think, on that day, so we see, as I sort of hinted at this earlier, but we see in the newspapers, the billions wiped off share markets in a day, but we didn't see the billions gained back when markets rallied by 9.5%, which is, the biggest day since GFC times, I think. One point I just want to raise here is on the 2nd of April, obviously with Trump announcing his tariffs with his little board that he was moving around, which was just a throwback to the 80s, I thought. But anyway, what we saw as a result of him wanting to raise tariffs was really problematic for the US government in the sense that we saw Treasury rates, as I mentioned earlier, go from 4 to 4.5. So that interest rate is essentially the debt that the US government has, and subsequently with an increase in that rate, that then increases the amount of interest they've got to pay back. And so subsequently, I think what's happened during that period is the key economic advisors, Scott Bessent being one of them, must have got to Trump in that period and said, we can't keep doing this because it's just going to keep going higher and higher. And so that's part of the reason why we believe that the tariffs were paused. He announced that pause, which was good that someone actually got to him. And so then, as a result of that, we saw the bond market stabilise, and then the current 10-year yield is sitting around about 4.3.
Yeah. Yeah, definitely spot on. With the market dropping almost 12% within a short period of time, as painful as it is, Trump seemed to be a bit insensitive to short-term market volatility, and what really spooked the U.S. administration seems to be the bond market.
Yeah.
So that's.
So seemingly it's all de-escalated in the
Yeah.
second half of the month, and so which is I guess why we saw the equity markets rally again, and of course he's looked to continue to impose tariffs on China, and China likewise back to the US. But there's been a significant de-escalation. But one of the things I wanted to draw everyone's attention to is in this chart here, we've got in the top right-hand corner. This is a list of average tariff rates, US average tariff rates on all imports from 1821 to 2025, and Lynn's done a great job of pulling this together. What we saw back before probably globalisation to the extent we have it now, so in the 30s and 40s, we had US average tariff rates that sat around about 20% at its peak during that period, but even previous to that, it got up to 40, 50, 60%. But for a very long period of time, almost through the 50s, 60s, 70s, 80s, and then through this century, we've had tariff rates that have sat in the US that have sat around about 2%, so maybe marginally higher. So that spike we're seeing, that projected spike we're seeing on the top right-hand corner, you can see why it's been such a significant change to how people think about global economics, because it's been this way for such a long time, which is why we've seen such volatility on markets. And we'll go through volatility in a minute, but that hopefully gives people some context as to what's been happening.
Yeah, you're right. Since the later part of the April, things is quieting down a little bit, and most of the headlines around the negotiation that are potentially going to come through, and some speculation on what would happen after the 90-day pause ends. So that's definitely something interesting to watch out for.
Yeah, it's very much a wait and see at the moment.
Yeah, exactly. But there are some positive signals coming from the U.S. administration. Even they are admitting that the current level tariff is not very sustainable.
Yes, that's right.
Yeah. So that's positive, and the market is reacting pretty well to that. They take that as some hope probably will come through, because they openly admit that it won't be at this high level, even with China down the track.
Yeah, that's true.
Okay, this slide is a summary of the U.S. economic data coming through in the past 1 month. There are lots of information on this slide. I don't think we're going to dig into every single one of them. But I guess from a broader point of view, there are some mixed signals coming through those data, but there's no major red flag, I guess, at this stage just yet. The underlying economy is slowing down, but it's still quite strong. We're seeing the U.S. market is quite resilient as well. There are some positive signals, like the data is better than expected, the main one being the core CPI. The last quarter CPI from U.S., it is 2.8%, down from the previous quarter, 3.1%. And it's actually below the forecast 3%. So it's showing that the inflation is easing.
Yep.
That's a positive signal broadly.
Yeah, that's right. And I think what's also really important there is the US Federal Reserve wants to see inflation between 2 and 3%.
Yep.
So the core CPI sits at 2.8, but then obviously the actual inflation rate, the other one they look at, sits at 2.4. So it really is in the middle of the range, and they've already started to reduce interest rates. So that's really quite positive, actually, when we think that through.
And some other data that turn out to be stronger than expected include retail sales, non-farm payrolls, as manufacturing PMI, service PMI. I guess the underlying theme across all those positive numbers is consumers and the business, they are rushing into buying more product and goods in preparation for the anticipated tariff imposed in April.
Yes, yeah, that's true. Yeah. Some of the negative signals there, we just most recently had the consumer sentiment numbers come out of the US, and they fell down to 52 from 57, which is the lowest they've been since 2022. And obviously we had some GDP growth data come out of the US as well, which was actually a negative. So it was a quarter of negative growth. That's not a recession. A recession is 2 quarters of negative growth, as we probably all well know. but that contracted by 0.3% in the first quarter, which has been the first decline in quite a few years, primarily, as Lynn just pointed out, as a result of importers, people rushing in to get in before the cost of whatever they were importing increased by whatever the Trump's tariffs are going to be.
Yeah, the GDP data is a bit surprising, and it looks concerning on the surface, but if we really look into what is driving it, it's just the imports data is the key factor, and a secondary factor is the government spending. Actually, this is in line with what Trump's policy anyway. He wanted to cut government spending, and unfortunately, as a result, you will see the GDP would come down as consequences.
So yeah, just to finish on this one, the economic data that we're seeing out of the US is still pretty strong.
That's right.
It's still the economy is still going along pretty well. We've got we've got unemployment rates which are okay. We've got services and manufacturing PMI numbers which are all greater than 50, which is kind of what we want to see. Retail sales have been really good. It's just that there's always going to be these little things. So we just need to obviously continue to watch, which is what we're doing.
Yep. Now let's bring it back to Australia. We have some good data coming in the past 1 month as well. The top one is apparent inflation, and the positive news is we are seeing annual headline inflation down to 2.4. That is the lowest we have seen for quite a few years now. As you pointed out earlier, the target range is between 2 to 3%.
That's right.
And I feel like it wasn't too long ago when we were talking about inflation at level 6 to 7, but it was 2 years ago. And since then, it has been steadily declining.
Yeah.
So that's a positive sign showing that inflation is under control.
Yeah, look, I think the RBA has done, I'll say this out loud, the RBA has done a pretty good job of bringing inflation back down to a normal level, 2 to 3%, while still maintaining economic growth in the economy. So what we've seen is, as you pointed out, inflation numbers got very high, and of course then what we saw is interest rates rise to try and combat that high level of inflation. Now, a lot of this goes to, well, we're back in the range, we're back between 2 and 3, economic growth is still there, when are interest rates going to fall, so those that have sort of got mortgages don't have to pay as much on our mortgage. Now I think there's an RBA decision meeting next week, I believe, and it's expected that there will be a cut. So I guess only time will tell, and when we go back on this podcast, we can work out whether that was right or not. There's supposed to be a cut, 25 basis points, might be up to 50 basis points, which will be pretty significant for those of us with significant mortgages. I mean, look, you've got $1 million mortgage, if you get an interest rate cut of 0.5%, then you've saved yourself $5,000 over the course of 12 months, which is significant. So I think Australia's been fairly resilient in terms of its economy, as per usual. GDP growth is still there. It is a bit below trend at the moment, so we're sitting down at about 1.3, 1.4. But we've still got positive growth. We're not in a recession. We haven't had any negative quarters of growth. So, given global trade tensions, high interest rates, and economic slowdowns elsewhere, the Australian economy is proving quite resilient.
Yeah, that's absolutely right. And for economy like Australia, the target range for GDP is roughly 2 to 3%. And in comparison, 1.3 feels a bit low, but it's still moderate growth. And it's a pretty sweet spot to be in considering the current situation we're in, because you don't want GDP number to be too high because it shows the economy is overheating, and that may cause RBA delay lowering interest rate. And of course, you also don't want it to be too low because then will bring concern and worries about getting a recession. This slide shows the trade position for Australia. I guess this is just further support the view that in comparison to many countries globally, Australia is pretty well positioned. And in terms of the export partners, it's no surprise that China is the biggest partner for Australia. But other than that, Japan, South Korea, US, India is pretty diversified. It's not overly concentrated. I guess one big highlight is US is only a small component of the big picture in terms of export. And also Australia is actually having a trade deficit with the US, which means we're not the target for this tariff
The US
war.
trade policy.
Yeah,
that's
exactly.
Right. Importantly, there, China, Japan, South Korea, and certainly China, US pales in comparison to China as an export partner. So, I'm not saying it's not important. It is important, and if there is the 10% tariff that Trump's promised, it will be, will have an impact, but it's not going to be too significant for Australia. And again, that just goes to the point that Australia is fairly resilient.
Yeah. As mentioned previously, in the past 1 month, there's no shortage of headline talking about volatility, and we are constantly telling the clients that this is something we're gonna see in the coming months and foreseeable future. But I feel it's very important to put things into perspective and what sort of level of volatility we're looking at right now. And here we're looking at this CBOE volatility index, VIX index, showing where we are positioning right now within the past 5 years and also for the past 20 years and longer. And as you can see from the chart, there is a sharp spike in early April as the result of the Liberation Day announcement. But since then, the volatility has come down to the level similar to 2022, 2023. And also, if we look at the bigger picture, back in 2020 COVID area, and also the GFC and 2000 .com crash, we are not seeing we're not seeing the same level of panic just yet, and hopefully this is just a short period in the big picture.
Yeah, it's an important chart, this, I think, because the VIX measures volatility, and if you look back to 2008 there, we saw, a very significant volatile time. COVID was similar. We're obviously nowhere near that now. So for a historical context, when you, like most of these charts, when you pull them out a little bit, you tend to see that the volatility, it's just one factor. And of course, what we talk to our clients about, Lynn, is making sure that you are almost naive to the volatility. So it is part and parcel being invested in markets. And importantly, this VIX measures, it measures the US S&P. So it is just one part of the portfolio, and which we'll run through next. But it's it has been volatile, but there's been times in the past where it's been much more volatile.
Exactly. The key message is the volatility is just part of the journey.
Yeah,
and
that's right.
Historically speaking, we see a market drop 10 to 15% at least once a year, but it tends to recover pretty quickly if we look at the historic pattern.
All right, so look, from a long-term perspective, and I think this is really important when we're considering clients' portfolios and how they're invested and that sort of thing. So when we have a look at this, we can see on the right-hand side there, we've got a table, and it dates back to the early, the 20s when the Depression was, and runs all the way through to 2025. So if we cast your eye to the right column, what you can see this century is we've had some negative returns in US equities. So this is the S&P 500 for context. And those negative returns, obviously early 2000s, the tech wreck, minus 13, minus 23. US equity market then rebounded and we saw significant returns. Then we had the GFC 2008, it was a minus 38%, and then significant returns again. And then, of course, we had COVID, where we saw a minus 20% return in US equities in that calendar year. We fast forward to where we are today, and with all the news that you see as part of newspapers trying to sell newspapers or clickbait or whatever it is, what we've seen this year is a minus 3% so far this calendar year. Yep. So in the context of thinking about all the headlines, it's actually not that. It's not significant at all in the context of where we've been. And importantly too, the 23 year and the 24 year, we saw a 24% and a 23% return out of the S&P 500. So it's markets can be volatile, But as part of the volatility, you have to accept the downs the ups with the downs, and that's, I think, what this table speaks to, is that longer term the US equity market is averaging 11% a year since its inception. But you see volatility in the short term, and the most important message here, I think, is to stay the course.
Yeah, definitely.
And look, I've got to say our clients are fairly well versed in this, because this is what happens every time we speak to them, really. But staying the course is the most important lesson that you can learn, because imagine that you jump out after Trump's tariffs, and we saw a minus 12, and then you jump back in
you miss
after
out.
it's gone back up by the 9.5% of the day. So there's volatility is part of all this, and that's the messaging. But also, in addition to that, diversification is also really important. So we don't have, of course, in our portfolios, we're not going to say to clients, you should hold one stock,
Definitely.
or you should hold 3 stocks or 20 stocks, nor are we going to say that you should hold one asset class. Diversification does its job, because what it then means is that you've got a diversified portfolio of assets, all of which are providing little pieces of return over a longer period of time. So it reduces the volatility, that's what it does, and it means that the return becomes more reliable.
Definitely, in a condition like this, the key message is stay calm, don't make knee-jerk reactions, and as you mentioned, diversification is the key, and this is how we put together our portfolio for our clients, and we're trying to invest across all the different asset classes, and we're not putting everything into one sector like US.
No, that's right.
Yeah, definitely.
Yeah, it's diversified.
Another interesting point is the behavior finance, and this is where it comes in. People tend to feel more pain when they see market drop of 10% as opposed to increase to 10%.
That's right.
And people quickly forget how strong the market has been in the past 2 years. And with all the news headline, it feels like it's doom and gloom all over again. But for most part of the year, we're pretty much moving sideways with only 3% to 4% drop.
That's right.
To date.
And I think part of working with financial advisors is the reminder of that too, right? So, exactly. So I think overall markets are going pretty well. So considering all the things that are happening, economies are still fairly strong. Of course, we're watching it with our investment partner, Willis Towers Watson, as well. And part of what we're going to be doing is continuing to have these updates and speaking to people about how the world's going. Finally, a disclaimer. So this is all just general information.
Yes, it's still a dynamic situation.
Speak to your advisor if you've got specific things you want to talk about with respect to your own portfolios. But yes, general information, and it does not take into account your personal objectives, financial situation, or needs. Thanks very much. That was great.
Thank you.
We'll see you all next month.